In focus this morning, integrated electrical power technology company Pestec International. Kenanga Research had a recent engagement with the company. It kept its rating at outperform, but it trimmed its target price to 66 cents from 87 cents previously. The stock ended trading yesterday at 46 cents. So, key takeaways. Pestec guided for lower revenues of 700 million ringgit to 750 million ringgit in FY22 to FY23, down from 900 million ringgit to 1 billion ringgit previously, citing challenging market conditions. It also sees PAT margin easing to 5% to 7% from 9% to 11% normally, due to the higher cable and copper costs, which have risen by 30% year to date. Under the current volatile input cost environment, Kenanga said Pestec is gravitating towards cost-plus new contracts to shield it from margin erosion experienced at its existing jobs, especially transmission line and substation projects. On the bright side, prospects of the industry over the medium term remain positive, underpinned by several rail electrification projects in the region, such as the new metro system in the Philippines and the new Orange Line in Bangkok. And while cost pressure and weak billings may persist into the next few quarters, Kenanga said the start of KLIA Aerotrain in the fourth quarter of FY22 should help to gradually improve Pestec's earnings. The research house lowered its FY23 revenue assumption to 750 million ringgit from 1.05 billion ringgit and cut its FY23 net profit forecast by 25% to 52.5 million ringgit, though it left its FY22 net profit estimate unchanged at 50.6 million ringgit. So what's the consensus? According to Bloomberg data, Kenanga is the only one covering Pestec. So that's one buy, target price 66 cents. Pestec settled at 46 cents yesterday, so that's a potential upside of about 43%.